Good morning and welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Here are the stories we're following today. Joining us now is Patrick Kennedy. He is founding partner at AllSource Investment Management. Patrick joins us from Hartford, Connecticut on the eve of the U.S. election. Thanks for making time to chat with us. Can we talk a little bit about what's at stake right now in terms of the election, not just in terms of the presidency, but control of Congress as well? How do you see things right now?
Yeah, I think either way, Doug, the macro view for, call it the next 5 to 10 years is kind of set in stone in our view as far as the risks go. So we think the next 10 years is going to be very different than the last 10. And in our mind, whoever's in office, it's not going to have a huge impact on it, right? So we think, the last 10 years, we had low rates, low inflation, fairly low volatility, not much going on with geopolitical stress. Fast forward to today and looking out over the next 10 years, we think is very much the opposite, right? We're going into a higher rate regime. Inflation will continue to be sticky in our eyes. Geopolitical events are happening overseas, lots of volatility. So what we're telling investors is that the thing that we really need to be careful of right now is recency bias. So a lot of folks are focusing on what worked the last 10 years, thinking, hey, it's going to work the next 10 when we're in a very different environment. Now, the election will impact that somewhat, right? But, in our view, inflation is more of a fundamental problem that's here to stay and isn't going to be corrected by, any one presidency, unfortunately.
Well, that's interesting. And it takes us to the Fed. I mean, right now, conventional wisdom is expecting the Fed to cut rates 25 basis points this week. Some in the market expecting another 25 in December. But you think that's not right. Am I reading that correctly?
That's correct. I mean, so if you go back to the 70s, right, as soon as the Fed started cutting, inflation roared back with a vengeance. We're not saying that's going to happen this time around, but we are saying inflation, again, is a little stickier than what most people think in our eyes. You have a lot of fundamental forces that are driving it. When you look at the deficit alone and the national debt, right, it's eye-watering. So that alone is going to cause a lot of issues with inflation. Then you pile on top of that supply chain onshoring from COVID, a lot of the other secular trends out there. We think that, again, it's here to stay. And with the Fed cutting, you might not see it pop up immediately, but we feel it will come back in short order.
So translate that into an investment strategy. At first blush, I'm thinking, okay, I avoid the bond market, but what do I do?
Yeah, that's a great question. So we're focusing on a few different areas, one being commodities. Okay, so commodities is so under-owned right now. When you look across institutional investor pools, almost no one talks about commodities. We think that market, because it's so under-owned, has plenty of inefficiencies that you can exploit, and it ties right in with the environment, inflation, higher rates, so on and so forth. Some of the things going on in Europe, disrupting supply chains.
So you're talking about the very brief longshoreman strike?
Correct. Yeah, correct. So that can create some short-term inefficiencies in our view within commodity markets, which you can capture with the right commodity strategy. So I think that within a commodity strategy, you want to have both a cyclical view and a secular view. The cyclical, more so to take advantage of some short-term dislocations, if you will, and then the secular aimed more towards taking advantage of some of the longer-term trends, such as the inflation we're talking about, such as the higher rates we're talking about.
So when I think commodities, I automatically think of oil. I don't know why. There's been so much volatility in the crude market lately. We've got OPEC scaling back plans to increase production, so that would be bullish. But a lot going on between Israel and Iran. And the other thing that doesn't get quite as much attention is what's been happening recently with the dollar and dollar weakness and how that's kind of put a floor underneath the price of oil. How do you view the energy complex right now?
We really like energy, especially within the private markets. So when you look at the public markets, valuations are very cheap right now, right? But the motto for the public markets has very much been, hey, maintain production and then pay out cash flows via dividends to investors, okay? There's not much growth in that equation. And I think one of the big reasons is because that space has been starved from investment dollars going back the last 10 years, right? So things like ESG and Other reasons, there's been large institutions, private equity firms, banks, pensions, so on and so forth, that have just pulled away from the space completely. In our eyes, that's going to be problematic over the long run. So when you look at energy consumption as a whole, right? So you look at, go back to 2000 and then fast forward to 2020, global energy consumption increased by 50%. Okay. Most of the projections say between now and 2050, global energy production will increase by yet another 50%. So the way that most investors are acting right now is, okay, we'll be able to build out this renewable infrastructure, which will take the place of oil. Well, first thing, no energy discovery has overtaken previous energy sources in the past. Okay. So anytime we've come across a new form of energy, it's never totally replaced previous forms of energy. It's been an addition to. Okay. And it's because of the massive demand we have as a human race for energy. With that being said, we anticipate this demand to pick up and supply needs to be there. When you look at private markets, particularly in the energy space, they're not geared towards growth whatsoever, right? So again, anemic investment into the space has caused this big dislocation. So we feel money will have to come back into the space eventually when that dislocation rears its ugly head.
So I hear what you're saying when it comes to renewables, wind, solar. But the other thing that's really become a hot topic lately as a result of a lot of the power demand, especially where data centers are concerned, the whole artificial intelligence trait, has been nuclear. It's certainly come back into the forefront as maybe a solution. How do you feel about nuclear as kind of a countervailing force somewhat to conventional carbon forms of energy?
I think we're going to need all sources of energy going forward, Doug, right? So I think there's absolutely a spot for nuclear. There's absolutely a spot for wind, solar, so on and so forth. I don't think any one source is going to be powerful enough to replace oil, gas, or the majority of what we need as a human race for energy demand, right?
So I want to turn our attention to talk a little bit about markets offshore, especially China, because we have a top legislative body meeting this week. They will review a lot of financial work and hopefully come to some kind of agreement on a little bit more in the way of stimulus. We're talking about trillions of yuan worth of stimulus. Now, some will go to fortifying the balance sheet of state-owned banks, and that is critical. Not many of them are not really in a robust shape. But the other thing that's especially critical is to help some of the local governments in China with their financial stress. How are you feeling about some of the movement that we are seeing in China to apply a lot more in the way of stimulus?
We're paying close attention to it, but we've always been very cautious when it comes to investment into China, simply because we feel like it's tough to really have eyes into what you're investing in within the country. When you have a communist regime that's running things, it's tough to see exactly what a company is doing and what their ties are to that government. On top of that, I think that China has some structural issues that hopefully stimulus will give it a leg up, but they're going to have to fix some of these structural issues as well as provide stimulus. And one of those is, you mentioned municipalities. I think I saw a stat where the revenue for municipalities within China, 40% of it is reliant on land sales. Okay. So when real estate collapsed over there, not only did it affect, huge conglomerates within the real estate market, but it also hit their municipalities in a big way. So I don't know how they're going to make up for that size of a gap when it comes to taking a chunk out of revenue like that. 40% is quite a number.
Patrick, we'll leave it there. It's always a pleasure. Thank you for making time to chat with us here on the Daybreak Asia podcast. Patrick Kennedy is founding partner at AllSource Investment Management, joining us from Hartford, Connecticut. Joining us now is Adam Coons. He is the Chief Investment Officer at Winthrop Capital Management. Adam joins us from Indianapolis, Indiana, on the eve of the U.S. presidential election stateside. Adam, thank you so much for taking time to chat with us. It was kind of an interesting day today. We had a slump in the equity market, yields down across the curve, the dollar weakened. A lot of folks were saying this was basically an unwinding of the Trump trade. Is that the way you read it?
Yeah, a little bit. I mean, if you looked at the action on Friday, it was kind of the reverse when you look at the dollar and treasuries. So, I mean, people are positioning or taking off positions. It's it's one of those where there's a lot of uncertainty, and I think the closer we get, and this is as close as we can get, there's just too much uncertainty. So I think you're going to see a lot of traders who have some sort of bet take those off because, you know, traders really aren't in the business of just gambling. And so I think when we get this close and the difference is really a coin flip, it's hard to be positioned with such a big news headline, market moving event headed our way tomorrow.
I think it's fair to say there's a pretty high likelihood that we'll get some kind of disputed result, and that could drag the vote count out for weeks, maybe even a month. We'll have to wait and see. But could that produce a lot of volatility in the interregnum?
Yeah, undoubtedly. I mean, obviously it's just going to increase the uncertainty, like I just said, and that anytime markets feel a high level of uncertainty, that's when you see volatility pick up. Capital markets, even if the scenario isn't necessarily ideal, if they understand it, can price it in, you can still have lower volatility even on a negative event. But when there's uncertainty about the outcome, that's when markets have a really difficult time pricing in the risk, and volatility just absolutely spikes. So yeah, you're spot on that if we did see some sort of contentious, result, I think we'd see markets just kind of whipsawing around, volatility, the VIX would pick up. So yeah, it would be a difficult time to be an investor or even a trader for that matter during a period like that.
So we've got the election. We also have a Fed meeting, and conventional wisdom indicates that the Fed's going to cut rates by 25 basis points this week. Is that pretty much your view?
Yeah, it's hard to go against that at this point. We're so close, and I think it would be difficult for the Fed to cut before the election and then pause right after the election. So I think that in and of itself, just for them to try to remain somewhat unpolitical, I think they will cut rates. The job number last Friday, too, was enough for them, I think, to continue to cut. I think you'll see the Fed really moving towards this period where they're just trying to equalize the market. I don't think that they're trying to aggressively loosen monetary policy. They're just trying to, they used the word last time, recalibrate. So I do believe that's really what they're trying to do right now. I think what we're going to see is one cut here. And I personally think they're done for the year. I would be surprised. There would have to be some pretty significant data to come out, either in the labor market or in inflation, to really instigate them to cut again. I think right now it's 75 basis points of cuts in 2024. And then kind of a wait and see is the more likely scenario from the Fed.
So the other market driver has been earnings. How would you characterize the results that we have seen so far, broadly speaking?
Broadly speaking, I mean, better than expected. That's coming off of, the bar was set a little bit lower. If you look back to the beginning of the summer, earnings, the expectation for earnings growth did start to decline as you move through the summer. But it is a way we came into this earnings season, and you are seeing companies beat, especially on the big tech side. I'm liking what I'm seeing, even if there is a little bit of excess CapEx spending that's hurting some companies. You are still seeing upside earnings growth, and I think that was really one of the fears throughout this whole year was, will we see an earnings recession? And the fact of the matter is, we're not going to. So I think this earnings season has been fairly positive, even though it has been, relatively in line. I think it's positive just that we can even do that and continue this momentum of earnings growth, revenue growth. It's a tremendous story for U.S. stocks.
So are you pretty upbeat as well when you listen to some of the guidance that these companies are offering?
Upbeat enough. I mean, I think, the growth that we've seen out of companies and the growth we've seen out of the S&P 500 the last 2 years has been very good. But when you look at the last 3 years, the S&P 500 is pretty much right in line with its 3-year rolling average. So I think, companies are kind of right in line where they should be. And unless we see some really significant rollover of the US economy, I just don't see anything changing. I think a lot of people just have been trying to look into some sort of crystal ball to determine when the next recession is going to be. And I think you gotta stop fighting that. Can you be defensive? Absolutely. But the reality is companies are still growing and the US economy is still growing. So I think you still need to be invested in stocks, maybe, be a little bit higher quality, lower volatility. But ultimately, yeah, I think, when you look at kind of the US stock market, it's very healthy right now.
So if I hear the word defensive in my mind, I go to the bond market a little bit. Are there opportunities right now in bonds?
Absolutely. I mean, I think right now is probably one of those prime times, you hear this idea of is the 60/40 portfolio dead? I think it is alive and well right now. When you've got valuations of stocks fairly in line. And then when you look at the bond market, that's my favorite place to be right now. I think this is that rare point in time where the risks are asymmetric, meaning that you've got three scenarios. You could have interest rates going up, you can have interest rates staying where they are, or interest rates going down. And I think the likelihood of interest rates going up is very, very low. But interest rates staying where they are, and I can clip a very healthy coupon, is attractive. Or if rates do go down, that's even more attractive. So I think 2 out of the 3 scenarios I win right now if I'm in bonds. So I think that makes it a very attractive place to be. Whether you're looking at corporates, I do like some of the mortgage-backed securities because you've seen spreads widen out there. But generally speaking, in investment grade bonds, is very, very attractive right now.
So how are you weighting overall geopolitical risk, whether we're talking about Ukraine and Russia and the fact now that we have North Korean troops in support of Russia in that conflict, then there is Iran and Israel. How are you weighting overall geopolitics as a risk for markets?
Well, the term we use is black swans here. And I think we've seen probably too many black swans over the last 10 years or so. So maybe an overused term. But what I'm really looking at is the fact that we've got more than one kind of building upon each other. And I don't know how any of these are going to work out. No one does. But when I see this kind of culmination of black swans, and I use air quotes there, when I see those start to kind of migrate together, that's when I start to become a little bit more cautious on, okay, something could happen here that is not priced into markets. And that's really what we're trying to weigh here. Are markets pricing in adequately the amount of risk that's out there? And I would say right now, they're probably not. And that's another reason why I like the bond market even more, because, if you saw some sort of geopolitical event happen, you would see a flight to quality and you would assume that bonds would outperform in that market. So that's another reason why we're overweight bonds right now.
I'm curious as to whether or not you're seeing opportunities offshore, particularly in Asia. This week in Beijing, the Standing Committee of the National People's Congress will be meeting, and the gathering really, among other things, will be to sign off on a fiscal package. It could be worth trillions in yuan. This is something that obviously the economy needs to take pressure off the local governments. At the same time, I think that there is a great deal of concern about some of the stress that the major banks in China are under right now. So a lot of these funds would be used to recapitalize the big banks, the state-owned banks in China. How are you feeling about the Chinese market broadly and perhaps some of the other economies that are linked to China economically?
This is a difficult one. And in the last round of stimulus headlines that came out, I was essentially saying this is a good start, but I'm not ready to move into that market until I see a further momentum into stimulus, because it just wasn't enough. I'm glad that I made that call and positioning, and I think this is one of those kind of wait and see stories. I typically don't like to do that in investing, but this is one where there's plenty of upside if they get it right, and I'm okay being a little bit late to this story rather than be early and be wrong. So I'm going to sit here on the sidelines and see how this next package comes out. If it is a package that looks like it's really going to help stabilize and stimulate, I will move back into that market. It's the China stock market is one that I've been salivating on the sidelines, waiting for the moment to be able to jump back in, because I think the valuations are just way too cheap. I think there's a lot of opportunity there. It's just a matter of seeing if that stimulus can kind of come in and really reinvigorate that market. So I'm hopeful for that. And if I do start to see momentum to the upside, I'd move in. Outside of the China story, I still like India. I think that's attached enough to, if you see growth out of China, it will just percolate into India as well, which has been outperforming already. So I still like that story, but outside of that, it's a difficult story. If you look at Japan on the developed side, I just think there's just too many headwinds, and so I'm staying away from that when I'm looking at Southeast Asia. But like I said, India, China, those are really the top plays there if we see stimulus pick up.
Good stuff. Adam, we'll leave it there. Thank you so much for making time to chat with us. He is Adam Coons, the Chief Investment Officer at Winthrop Capital Management, joining us from Indianapolis, Indiana, here on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.